Today we're going to be talking about breakouts versus stop hunts. Stay tuned, traders. We'll be right back. G'day traders, Stacey Burke from Stacey Burke Trading. It's Thursday. We've had 3 days of solid 50 pip moves each one of these days this week. And today we're going to talk about breakouts versus stop hunts. And again, just a reminder, October 15th, next Thursday, myself and Chris Weston are going to be on an episode of Professionally Speaking for Pepperstone. And that's going to be 7:30 Melbourne time, 5:30 Perth, Western Australian time, which is 5:30 a.m. New York Eastern Standard Time. I've got the link down in the box below. You can reserve a spot. It's going to be, I think we're going to have Chris has got a lot of data he's compiled. He's going to be going over a lot of charts. His strategy, his macro numbers for all the different markets that he's crunched. We're going to be talking about the British pound, and we're going to be covering a lot of short-term trade setups to look at how these basic systems can apply to other markets as well, based on the same rules. High and low of the day, the timings, the world markets work on the same timings of the equity market opens, and then how they can be profitable, because I think we're going to see a lot of volatility. So let's get started. One of the consistent questions that I get asked from traders is, how do you know you're not in a breakout for a trend trade versus a stop hunt? Now, the last couple of days we've dealt specifically with the timings, the equity hour specifically, that 1 hour in between the 12 candle window where the equity markets open in London and in New York, and it can be applied to Asia as well. But the importance of understanding that hour often will be at the extreme, either after the stop hunt for the reversal, or to complete the stop hunt and then reverse, as we saw last night in the US session, a 50 pip stop hunt in less than a minute. And often, as you may experience, as several traders emailed me saying their platforms momentarily were froze when a move that aggressively happens. I don't know, sometimes perhaps maybe they slow things down to allow their books to bounce before they let traders back in the market. I'm not sure, but we saw the 50 pip move down, and then we saw the consolidation at the low of the day or near the low of the day on some of the pairs, and then the reversal for 25 and 50 pips depending on which pair you traded. Now today we're going to talk about the breakout versus the stop hunt. So I talk about that first hour often being the trap and the stop hunt. So if you go back and look at your charts, and we'll look at those today, isolating that 12 candle window, whatever session you're trading, it doesn't matter, but if you could just peel all the other data off the chart, you'll find that first hour often is the false move. So the false move and the stop hunt. And if there is no stop hunt in terms of breaking a high or a low, or heading towards a high or a low, you'll find that equity hour will complete the move, whether it's 1 bar with a pin through the high, or a 2 bar combination with a pin through the low, whatever that may be, but they will always hit the stops. Now, I repeat this phrase all the time, where is the money? Because if you are in the market prior to the next session opening and we're down near the low, so if we've had a move off the high and they've pulled it off the low and they're going into the US session, chances are they're going to revisit that level one more time. Doesn't mean they're going to go all the way to the low, because again, they may have already locked it in. They might have already put a peak formation in place, and they may just come back into traders who are already at break even or who are in the money before coming back. And then we have our middle structure. So some traders have asked me, what do you mean by middle structure? Well, that's what gives us our geometry for our smaller rectangle, whether that's 25 pips, it doesn't matter. It could be a 3 push pattern into a low where we get a little W formation, a couple of pin hammers right at the 12 candle window beginning in the US session. The difference for me primarily is understanding the timings. If the market breaks out prior to the equity hour, so if we're breaking to new highs or if we're breaking to new lows in that first hour, I will often perceive that as the stop hunt and the trap. It is tradable. You can trade that stop hunt. It may be a 25 to 50 pip move. We saw last night those fast moves to the low of the day were 50 pip moves. Now there were entries into those trades, and there is, again, you can trade the stop hunt for 50 pips in some cases. Now you'll notice on some of those pairs, depending on where your fill was, those pairs spiked exactly 50 pips. So if you were in the market at a less than 50 pip fill price to the low of that spike, you may have had a 50 pip target, but once it's gone to that low of the day and pinned back, the chances are if they're done their work down there, they're done their work, and they'll reverse that market to go back to the traders, i.e. the person who shorted that market, to get those traders either a break even or to reverse that market to continue back towards the high of the day, as we saw in the pound, New Zealand, and a couple of the other pairs. So timings again are critical, because that first hour, as the market starts to move, again, the equity markets aren't open yet, and if that equity market opens up high or down low, and again, we just watched the price action in terms of how it behaves. They may continue to extend that stop hunt lower or higher. Now we saw gold. We'll look at gold. They went up 2 more bars before reversing, so they went up into that equities hour, 1 candle. Then on the second candle, reversed it back, and that was the high of the day. We saw on the pound yen, it continued to move up in the pound Aussie in that full hour, that equities hour, and then went into consolidation. So that high of the day was in the equities hour. That last candle of the second hour went right to the high of the day before reversing in that third hour. So savvy traders who already noticed on a shorter time frame that the high of the day was in place, they went up a second time to the high before selling it off, and then engulfing that in the third hour for a 50 plus pip move back down towards the low of the day. So again, that equity hour, if we're up high and we're already moving, now I'm starting to, in my head, do the countdown in terms of timings. And depending on where we're at in terms of the price action, I may look at a shorter time frame to see if they've put a high or a low in place. And again, engulfments and pin hammers, that's the price action that's confirming that we've locked in that level for the reversal, either down low or up top. The difference being that versus a trend trade, if the market is going to trend and we get a breakout of a level, and it can be in that first hour, the stop hunt will often be back into the breakout before continuing with an engulfment back with the original trend. And again, there's our middle structure, but the timings in that equity hour, we will see the stop hunt and the reversal usually in that equity hour. The difference being is if the market is making bursts higher in that first hour, and then in the second hour continues, now we're potentially putting a high of the day in place in that equity hour. As the equity markets open, they drag traders higher up, chasing that move before locking it in and reversing the trade. The difference being they break the market out in the pre-market, and then the equities market stop hunts back into the breakout before engulfing and reversing for at least a retest of the high. So again, think about what's happening. They trap traders shorting the market just prior to the equity market opening. They get traders shorting it, collecting stops above those levels where retail traders are placing their stop loss orders, and then bang, they hit it and do a measured move or drag it further out. Now again, that can come back to our weekly template and where we're at if we have a narrow range day in that previous 2 days, so we get a breakout and a pullback and a continuation. I will put the link below for the narrow range day on the daily chart indicator. Again, a lot of people have asked for that, and I'll gladly put that in the link below. I've left the numbers off the charts the last couple videos specifically just to focus on paying attention to the high and low of the day and the timings, because they are critical. But this round number area, we can go back and look at pretty much any chart. We'll see that those charts typically are moving from 50s to zeros or zeros to zeros. The pound loves double zeros. And again, a 1 bar stop. If we're up high, that 1 hour, that 1 bar, we might have 3 bars sideways. It's a 1 bar stop. We're looking at 20, 25, depending on the pair and the spread, sometimes a bit more. But when those markets lock in a level and they're going to reverse, and they've put the pin hammer in place, very rarely will a market ever come back even close to touching your stop. It will move away quickly. So I've talked about that in previous videos. When these trades are right, they don't hang around. They move quickly. Now, if you get in early, you can still be at the high and the market will consolidate underneath of the high or on top of a low for 2 or 3 bars before it moves away, but it does not trade against you other than into your fill price. And then we're targeting 50 plus or minus or more pips per trade. So again, if we're in a narrow range breakout trend trade, we could be targeting maybe 150 pips. If we're in a normal stop hunt back to the high or to the low of the day, we're typically going to be looking at a minimum of 25, but normally 50 pips, especially if they've moved it 50 from top to bottom. Coming back to our original, just simple model, we'll talk about some of those reasons why, and that's consistency. So I know that 90% of the time the market is going to move in that first hour, but I know that often that's what catches traders chasing the move, and there are scalpable, there's some good trades there. Like yesterday we saw the pound yen move from 50 to 90. That's a 40 pip move. Those are all tradable moves, and you want to be trading with that initial burst. And coming back to our understanding of the previous day's highs and lows, and also where the previous session's profitable trades are. So if we're not near a previous day's high or low, we have the current high and low of the day. If they break through that range, we want to be identifying where the profitable trades are from the previous session. So what do I mean by that? If you shorted the US market the day before and you were up 50 pips, and they break out and they're moving back towards your trade, as you're losing money, they're coming to stop you out, usually at a minimum of break even, and in some cases they'll come right back through to the high or low of that session to make sure that, again, the golden rule, to make sure that as many traders as possible are disappointed and don't leave with any money in their pockets. So a lot of this just consistency, simplicity, timings, high and low of the day, engulfments and pin hammers, because I can reproduce this every single day. And for those of you who have been following me, and I've received hundreds of emails and comments, you're seeing the same things now every day. They lock in the high, they lock in the low, they get traders chasing moves, and those are tradable. Again, they're tradable moves in a lot of cases, unless they're jamming you into the high or to the low from the previous session, and then they lock it in and they move away quickly, or they put a middle structure in place. And even that 25 pip move to put a middle structure in place is enough to stop out most retail traders. So when they come back from a high or a low, when they move at 50 pips, that is usually enough to blow out most traders if they have a stop loss in place. And if they don't have a stop loss in place and they're over leveraged, that can be enough to margin out their accounts. So be patient. There's going to be a trade in each one of these sessions, and that's the most important thing to understand. If you feel like you're chasing a move or you're missing out, again, understand the timings. Once that middle hour has completed, you are probably at the high or low of a session, if you're not at the extreme of the previous day's high or low. If we've broken out, that middle hour will often, they will complete the high and low of that range in that middle hour in most cases. And that third hour can be the retest of that extreme, whether it's down low or up high, before reversing. So if we get a third hour trade set up, usually that third hour is the second retest of a high or a low, because the first hour was a stop hunt. The second hour puts a low or a high in place. The third hour retests it before they lock it in and shift the market. If it's a trend trade, that second hour will extend the move. So again, 25 to 50 pips. It may be a 50 pip move. If it's a trending day, they'll usually stop hunt back into the trend before continuing for a measured move of the geometry that they've broken out of. So we'll look at some charts today. Again, thank you for a ton of feedback. A lot of great results for a lot of traders. Just sticking to timings and high and low of the day has made a big difference for a couple of traders. They've sent me some results that are just outstanding. And again, just reminding everybody, next Thursday, October 15th, 1 week from today, myself and Chris Weston from PEPPERSTONE will be having a 45 minute webinar and 20 minutes of questions. I've got the link in the description box below. We're going to be going over gold, equities, S&P, the elections, the upcoming Brexit deal that's being worked out, the gold market again, oil. Going to be looking at a lot of different markets. Chris is he's compiled a lot of data that he's going to be going over and showing us some very, very interesting statistics. And for those of you who've heard Chris before, he's an absolute genius. I learn something from him every time we chat. But we're going to be going over a lot of stuff regarding the British pound and the intraday strategy, how we can potentially be profiting from that. I think we're going to have a lot of volatility coming up in the next few months on a lot of markets, and these same principles apply. I've been following gold. We're going to look at gold again today. The same things apply. So just to reinforce, want to stay on the outside during that equities hour, waiting for them to hit the stops, and then placing calmly your position in the market, putting your stop loss in place, and 50 pips, targeting that. And if we get to the high or the low of the day and the market stalls or goes 1, 2, 3 and we haven't quite got the 50, I'm going to call it a session. So stay disciplined, traders, stay focused, keep getting better. This is a winnable game. Have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, talking about the difference between a breakout and a stop hunt today. Looking at the different pairs, we're just heading into the Bank of England. Governor Bailey just about to speak here on the British pound crosses. So we saw a breakout in that first hour, again the 1, 2, 3 outside of the range, and then the London candle engulfed at the very first candle of the London middle hour, and they went 1, 2, 3 back to the high of the day. And from there the market went sideways. They hit the stops, so we had 1 hour, and again you'll notice that the fourth candle of that hour put the high of the day in place. They went up one more time and pinned it, and then engulfed it, and then performed the measured move all the way back down through the low of the day. Then as we headed towards the beginning of the U.S. session, they pulled it back sideways for 1 hour, and the equities hour spiked down through the previous day's low before they went into consolidation again. And at the end of that second hour of the equities, the third hour started and engulfed that whole lower section. A little bull candle to solidify that, and then straight back up, getting traders who shorted the market. So again, just coming back to the timings factor and the difference between a breakout and a stop hunt. So we saw the breakout, and then we saw the stop hunt back into the trade. So they came back inside in that equities hour, as opposed to extending the move out, which we saw on the pound yen, which we'll look at in a second. And then they continued the move down towards the previous day's low. So again, as we head into our Governor Bailey, I believe from the Bank of England, is about to speak, we're at the low of the day, and we'll watch how this equity hour performs to either extend down to stop hunt or come back towards the high of the day, getting traders who are short in the Asian session. When we look at the pound yen, so we look and we see that the market, as we mentioned, put a W formation, peak formation low in place. They went down, they came up, gave a middle structure, went down in the equities open, and reversed that heading into the end of the Asian session. And then sideways that first hour, and you'll notice the double bullpen hammer to complete the hour. So 2 bullpins, an engulfment and 2 bullpins. And then the London market continued to extend that move up. So the equities hour continued the stop hunt. So the pound yen was an example of a breakout and a tradable breakout. So some traders were already long. We saw the big move up the shift candle. We had a flip zone pin from the Fed the night from previous announcement the night before, or a spike stop hunt. But then they had the double pin, and then they extended the move out in the 12 candle Europe London window. The London equities hour extended that move. So again, 1, 2, 3, fourth candle. The fourth candle out to the high, and then the last candle of the hour, that actually locked in the high of the day. That consolidation after the equities hour extended move is the first clue. We see that middle structure. We'll blow this up for traders. That middle structure, and then the right shoulder, and then the engulfment, and then the little bear pin hammer, which again is that second stop hunt into traders who have shorted the market before dropping back and stop hunting traders who were in the original breakout move. Then we see the stop hunt back into the traders that are short in that first hour. So again, there's a move in that 7 o'clock pre-market stop hunt hour, and they go 1, 2, 3 sideways, and then the equities hour performs the stop hunt. When you see this pin down through the low into the Asian session, and they pull back and go into consolidation, the work is done down below. They're going to go back up towards the high of the day. They engulf it, and the market moves away. Again, all this volume, you can see again just these 1 push, 2 push, 3 push patterns. When they're done their work, they move away in 4 bars for 50 pips very quickly. As they did here, they moved away quickly. That Asian session breakout trade was a 50 pip stop hunt back up to traders who were short from the previous session. Now again, looking at gold, we saw that peak formation low formed on the stop hunt to the previous day's low in the equity hour. They reversed and went through the high of the day. And again, we'll just draw a little line in here. And again, pin hammer at the end of Asia. They break out of the range into that Europe 12 candle window, and they go up in that equities hour, first, second candle for the reversal. Again, the high bull, but you'll also notice this is a stop hunt on traders who traded the breakout from the previous night's U.S. session. Then the market locks in that. Then we notice that the high bull gets locked in, and the market then drops away to stop hunt traders who are on the breakout. But the key is understanding that timings-wise, we see a breakout. If the market was going to trend, we would see the stop hunt back into the trend in that equities hour, and then the continuation for a trend trade. They extended it out to lock in the high of the day before bringing traders back into the breakout for the stop hunt back, and then trapping them inside before going into consolidation. We had the low of the day, we had the high of the day. The market stop hunts back into traders that are short, and then pulls back into consolidation in the U.S. session. So looking at the pound New Zealand, we can see that it went up to the previous, the high of the day from Asia, the Asian range, and then went into consolidation. So first hour did not make any moves to the high or to the low. Then we saw the 1, 2, 3, 4, the last candle of the equities hour, and the consolidation right at the high of the day. So we've got 2, 4, 6 bars at the high of the day, then a little bear engulfment of the small bull candle before dropping back down and pinning down through the low of the day in the U.S. Open. So again, just timings, high and low of the day, no previous day's high or low hit, as opposed to a breakout pullback continuation. We see a stop hunt to the high of the day, doesn't break through, doesn't follow through before coming back inside and then stop hunting back towards the low of the day. So trend trades are going to break out, pull back into the breakout in the equities hour in most cases, and then continue before that hour is over. It'll usually be a 2-3 bar pullback maximum before continuing, so that second hour continues the move in most cases. So just in closing, looking at the pound, we'll take another look. Again, just another example of a breakout. And again, the stop hunt continued and extended into the London hour before going into consolidation. And again, just looking to your left, we see that hour fully stop hunt into the breakout, as opposed to that first hour breaking out and pulling back and then continuing. We see the equities hour extend the move for one full hour and then go into consolidation and engulfing and reversing back towards the low of the day. They stop hunt back into the range just at the beginning of the 12 candle window for the engulfment, and the equities hour stop hunt to the low of the day. This fast pin move through the low and pulling back doesn't allow traders to get filled at the low of the day unless they have limit orders, and it stops traders out, goes into consolidation. Traders who have shorted this market are stopped out immediately on the second candle. So it pins down, it pins back, goes into consolidation, and then moves back towards the high of the day. Equities hour timings, as opposed to a breakout pullback and a continuation where these markets do not come back, the stop hunt will extend and go into consolidation, or go into consolidation and then reverse. Hopefully you got some value from today's video, traders. Again, just coming off of our speech from Governor Bailey, BOE, another question about news. I don't typically trade in front of the news. I will allow that candle to complete itself unless we have already had a strong move taking traders 25 to 50 pips away prior to that news and going into consolidation for a stop hunt catalyst on the news event itself, which we'll talk about in one of the next few videos. Again, the Pepperstone event on the 15th. Book your spot below. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.